Here we go. While U.S. equities have reclaimed most of their losses for the year, with the S&P now pretty much flat for 2012, well, emerging market stocks, not so much. They do continue to lag. In fact, the MSCI Emerging Markets Index is down about 14% for the year. But our next guest says the policy shifts in both emerging markets and developed economies could bode well for emerging market stocks. We're joined now by Jim Paulsen, Chief Investment Strategist at Wells Capital Management, the ever or eternally optimistic Jim Paulsen. Always good to see you. Thanks for joining us once again.
Thanks for having me.
Jim, I found the piece that you wrote interesting. You took a look at some interest rate changes that were done in emerging markets, specifically Asian countries, I think, versus developed nations. And between the period of 2003, 2007, and we've got the chart up here, you can see the blue line there, emerging markets way outperformed S&P 500. That's not a technical term, clearly, but you can see a huge differential in performance during that period of time. Now, at the same time, we saw the spread difference between their interest rates come in quite a bit. Now, you say, based on this, that we're entering a similar period of time because we're going to start to see some of these emerging market economies actually cut their interest rates?
Right. I think it's already starting a little bit, Lisa. I don't think the magnitude, it'll be as great as what we had in the decade of the 2000s, but I think the character will be similar. What the emerging markets have suffered from in the last year and a half is that the emerging market policy officials, their Federal Reserves, if you will, have been raising rates and tightening credit conditions in order to try to moderate the recovery so they don't overheat. Well, that's a real difficult thing for those stocks. Number one, you're slowing the economies, and number two, you're raising rates. And as a result, as you just mentioned, they've underperformed quite a bit. What you now see just in the last several weeks or even couple months is many of these emerging market policy officials now are starting to ease interest rates and credit conditions. They've decided they've slowed down enough. And what you've got is you've got the emerging world easing and relative to the developed world. I think not only will that help speed up emerging world economies next year, but when rates are falling in the emerging world relative to the developed world, I think that it's often been a good signal that if you're allocating assets, it's a good time to allocate more towards emerging market stocks than domestic stocks.
All right, so from a timing perspective, makes sense. But when I think about that period between 2003, 2007, world was a very different place, right? We had the developed nations much stronger, in a much stronger position economically, and they were driving a lot of that growth in emerging markets. Is that not true? Where would their growth come from going forward?
Well, I think a bigger part of the emerging world growth is going to start coming internally. I mean, what we've done is develop these sort of emerging economies from where they were mainly export driven to where they now have their own sort of internal consumption force, if you will. That isn't completely done yet, but it's starting to get more that way. I think that I think the emerging story is still in place where you're going to have faster growth coming out of the emerging world than the developed world. But on top of that, if you have their interest rates coming down faster than what the developed world can lower them, then I think you're adding an extra element of outperformance into those stocks. And I think that's what we're headed for here. Maybe the bottom that we just saw here in the last month might be the low, not only for the stock market, but the low for the relative performance of emerging stocks as well.
Hey, Jim, let's quickly go over what else you like. And emerging markets are your top pick, but you also like small cap stocks.
Mm-hmm. I like in this country both small caps and also industrials. I think that in this country, the biggest thing that happened was the Japanese tsunami that screwed up the U.S. manufacturing supply chains. That's alleviating, and as it does, I think you're going to see a little bit of an industrial renaissance. And then I think small caps, typically they have higher betas, they have greater leverage to the domestic economy, which I think is starting to reaccelerate a little bit. And I think they have greater operating leverage if we reaccelerate. So I think they're also been beat up more. So I think the valuation draws me to small caps as well as the operating leverage if the U.S. economy starts reaccelerating again.
All right. Now you know why I call you the eternal optimist. Thanks so much, Jim. We got to end it there. Clearly, expectations that we're going to grow a little bit more than many people expect. Thanks so much, Jim. Look forward to speaking to you once again sometime in the near future. That was Jim Paulsen of Wells Capital Management.